The order states that tariffs are a necessary and appropriate way to punish India for buying Russian oil. Secondary sanctions could have a serious impact on the global energy market. So far, the reaction's been muted. Brent's at about, well, you can see the numbers there for yourself. If the West does go full throttle on secondary sanctions, then we may see, well, a reaction in quite the opposite direction as things move forward on that. That's, of course, impacts the cost of everything. Helima Croft is the global head of commodities at RBC Capital Markets. Good to see you. There's a problem here. You were just telling me a moment or three ago. It's all a bit odd because actually Trump or the US and certainly the EU wanted India to buy this oil to help enforce their own price cap.
Certainly, if you go back to December 2022, when the G7 went forward with price caps, essentially saying that you had to purchase Russian oil at $60 or below, this whole mechanism was designed to facilitate the flow of Russian barrels that were now locked out of Europe. When Europe basically said, we're not taking any seaborne oil from Russia, the price caps were designed to ensure that those barrels had a home, and the home was India. And India was perfectly happy to back up the truck and take a significant amount of Russian oil. Russian imports into India have actually climbed by over 1 million barrels since the start of the war. But again, this was by design. And hence, if you listen to the statements coming out of the Indian government today, they're very, very angry when it comes to this energy dimension, essentially saying, like, wait a second, this is entirely unjustified. So we do have to wait and see what happens on Friday, because on Friday, that was a deadline for the 100% tariffs. So are more tariffs coming on India? Again, is this just a bargaining chip? Is this escalate to de-escalate? But the one thing I would say is that President Trump is facing pressure from Congress to really go after Russian oil exports. So this could be a multi-purpose move.
It's the way it's being done, I guess. The sort of the 25% plus the 25%. Yes. I mean, if, let's just, as the experts, ma'am, if India does, well, first of all, do you expect them to stop purchasing Russian oil as a result? And if they did, what would be the effect on the market?
So the question is, like, how serious is this measure? Now, we are talking about secondary tariffs. Now, tariffs are a different tool than sanctions. I mean, tariffs can be, imposed and taken off within, like, hours. If you have something put in place by OFAC, or if Congress goes forward with secondary sanctions like they did on Iran, the unwind process can be more protracted. And so the question is, what is the duration of the measures that President Trump talking about? That will impact the market in terms of, like, is this real? Is this rhetorical? But certainly, if the United States was serious about getting India to reduce their Russian oil imports, they could impose secondary sanctions on the two biggest Russian energy producers, Gazprom, Rosneft. They could do Iran-style sanctions. And because the key Indian refineries are so integrated in global financial markets, you could probably get them to pare back their purchases if you wanted to.
Now, while I've got you, it's too good to waste the opportunity. All these other sanctions on things like copper and all the other commodities that are being, they're designed to increase production at home. They're designed to shift production. But are they going to work, or are they just going to push up costs for domestic production and U.S. consumers?
I mean, this becomes whole issues around supply chains, Richard, in terms of, like, what does that do? Like, let's even, for example, take something like, domestic U.S. production of oil. I mean, when you put tariffs on steel, that does increase cost for U.S. producers at home. So it all comes back to, like, what are your supply chain issues that you're dealing with?
Right, but I was reading in my morning newspaper, there's a contradiction, isn't there, between drill, baby, drill, and wanting a higher price for oil, because the more you drill, because the lower the price goes, and President Trump wants a lower price, then there's no incentive to go into the Permian Basin and actually drill the more expensive oil.
We just had the announcement from the Diamondback CEO that they are not going forward with production increases, essentially saying the market does not need more U.S. production at this point. You have OPEC putting on more barrels. You don't need more U.S. barrels. So this is the challenge for President Trump. He wants $50 oil, but he wants more U.S. production. Not compatible.
Well, I hope What is compatible is you coming back on Quest Means Business in the future and helping us understand this, because commodities are so important and we do need to understand. Thank you very much. Now.